The Fed keeps US rates on hold and softens its tone on growth. Australia's inflation paves the way for an August rate cut, and there are signs of weakness in New Zealand's economy. That's coming up in our 5 Things in 5 Minutes on Thursday, July the 31st. And then in our deep dive interview, ANZ's Matt Galt looks at what's been driving local council property tax rates up in New Zealand.
There are significant issues in infrastructure in New Zealand with, in some cases, decades of deferred maintenance to catch up on, and significant issues around providing enough infrastructure for housing supply.
But first, in 5 and 5 with ANZ, the Federal Open Markets Committee has just held the US federal funds rate in a range of 4.25 to 4.5% and lowered its tone on US economic growth, saying it had moderated in the first half of the year. ANZ economist in London, Bunzi Madhavani, says that's a fair characterisation of Q2 GDP data, which was released earlier overnight.
When you put together consumer spending and gross private fixed investment together, that grew at a decelerated pace. The FOMC also noted that inflation remains somewhat elevated and they assess labour market conditions to be solid. The notable part of the decision, though, was 2 members dissenting in favour of a cut. This is the first time since early 1990s that 2 board governors have dissented on an FOMC decision. We continue to believe that the FOMC is well placed to resume cutting rates at its September meeting. They note that, they are sensitive to incoming labour market conditions report and inflation reports, and our own expectation is that labour market is gradually cooling and we expect the tariff-driven inflation pressures to be one-off. So on the back of that, we continue to pencil in a 25 basis point rate cut in September.
As of just after the Fed decision at 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.2%. The 10-year US Treasury yield up just over 1 basis point at 4.347%. Gold was trading down 0.8% at $3,353 an ounce, while West Texas oil futures were up 1.1% at $70 a barrel. The US dollar index was trading up about 0.5%. The Aussie dollar down 0.8% at 64.60 US cents, and the Kiwi was down 0.6% at 59.21 US cents. Number 2. Australian inflation figures out yesterday should support the Reserve Bank of Australia to cut rates in August. ANZ senior economist Adelaide Timbrell says annual headline and CPI inflation of 2.1% in the June quarter was just below expectations, while the trimmed mean measure at 2.7% was in line.
Q2 inflation printed 0.7% for headline and 0.6% for trimmed mean in the quarter. The trimmed mean figure was a little below market expectations and will make it more easy for the Reserve Bank to cut rates. Some of the things that pushed down that trimmed mean inflation piece was some deflation in the quarterly data for the health sector, as well as some deflation in transport and particularly in fuel. When we look overall at the data, there is definitely some disinflation there after leading indicators suggested that this may have stalled.
Number 3. Adelaide says there was quite some focus on the data after Reserve Bank of Australia Governor Michelle Bullock's speech last week, highlighting the risks from a higher result.
The Reserve Bank do seem to have a bias for changing rates immediately after a quarterly CPI print, such as this one. The last 2 rate cuts did occur in the meetings right after quarterly CPI prints, and it does seem from recent commentary by Michelle Bullock, the Governor of the Reserve Bank, that quarterly CPI is much more important to them than the monthly CPI indicator, which makes sense. The monthly indicator doesn't have as much tenure, as much history, which means its seasonal factors are not as strong. It means that it's also less comprehensive. So they are still really relying on that comprehensive long-term view of inflation rather than the partial view that the monthly CPI indicator provides.
Number 4. Headline New Zealand business confidence rose 2 points in July to a net 48%, expecting better conditions in the wider economy, according to ANZ's Business Outlook. But New Zealand Chief Economist Sharon Zollner says that's masking economic weakness.
It's fair to say that business confidence and expected activity are still pretty high. It's just worth remembering, though, those questions are defined relative to today, so the starting point really matters. And in that regard, things are still pretty tough. The experienced owned activity is only at +6. That was up a little bit, but past employment down 3 points, -13. So that's consistent with our expectation that the labour market data next week is likely to show that employment's actually been going backwards. So it's clearly a pretty subdued economy out there.
Number 5. The Monetary Authority of Singapore left policy on hold at its meeting yesterday, as expected. ANZ Head of Asia Research Koon Goh says it's now a matter of wait and see on global economic developments.
After the back-to-back easings in January and April, the MAS sees themselves in a comfortable position and are ready to respond to any unexpected shocks in future. They have maintained their inflation forecast unchanged. Interestingly, they have not provided an update to their GDP growth forecast, though they did note that the Singapore economy has performed better than expected 3 months ago. Therefore, I suspect that they are probably in a process of upgrading their growth forecast, but probably awaiting for more information, in particular what's going to happen post 1 August with the reciprocal tariffs.
Koon Goh there. Now, in our deep dive interview, ANZ senior economist Matt Galt has been analysing how council property rates in New Zealand, levied on property values, have been rising much faster than general inflation in recent years.
Council rates have been going up really fast over the last few years, with annual increases of 7 to 12% and another increase of around 8.5% coming in the September quarter. So that would contribute 0.3 percentage points or so to overall inflation, which is, it's not huge, but it's still pretty material. We've seen some variation in the rate and the pace of council rates increases, with Wellington and Hamilton going up quite a bit faster than Auckland and Christchurch, for example. But all councils seem to have been under financial pressure and have been putting up rates at a fairly brisk pace.
What is driving these rates increases, and I guess what's the money being used for?
We haven't been able to dig into every last detail of each council's finances, but at an economy-wide level, there are a few things going on. One is that councils faced a lot of inflation pressure in their own costs, rising wage bills, construction cost inflation for their provision of water and roading infrastructure, like many other companies and government agencies around the country over the last few years. They've faced higher interest costs too, and they've been sprinting to keep infrastructure supply up with growth over the last few years, as well as recovering in some instances, such as Hawke's Bay and Auckland, from severe storms in 2023.
So those infrastructure costs are obviously a big part of the national conversation here in New Zealand. Those woes aren't going to be solved overnight. So are councils going to have to keep on keeping up with these sorts of rates increases?
We think it's likely that rates will keep increasing, but not at the extremely rapid pace we've seen over the last few years. Some of the pressures on councils are easing, those cyclical pressures like inflation and costs, and we've seen growth slow as well, which might give it an opportunity to catch up on some of the infrastructure deficits. But having said that, there are significant issues in infrastructure in New Zealand with, in some cases, decades of deferred maintenance to catch up on, and significant issues around providing enough infrastructure for housing supply. And as well as that, councils' costs of wages and construction costs do tend to rise faster than CPI inflation as a whole. So we would expect council rates to keep going up faster than overall CPI inflation.
And then just in terms of council financial pressures other than infrastructure, are they looking like they might ease? And even if that does happen, you'd still expect rates to continue rising faster than other prices. So what does that sort of introduce when we're looking at inflation and things like that?
The historical experience between 1992 and 2019 was that council rates did tend to rise faster than overall inflation. They rose at an average rate of 4.7% a year over that period. So it would be reasonable to expect that to continue, even if the pace does drop from the very rapid pace we've seen recently.
And just in terms of rates and or the cost of owning a home as opposed to the cost of buying a home, are you seeing these high rate increases affecting demand in the housing market at all?
Well, they're not the biggest factor in the choice about whether to own a home or not. Financially, the biggest impact would be from interest rate by far. But at the margin, higher council rates would be discouraging people from owning a home or encouraging them to offload a property that they're no longer wanting to hold. So at the margin, it would be having a small impact holding house prices back.
Matt Galt there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 31st. Catch you tomorrow with analysis of the Bank of Japan's rate decision later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.